Investing directly in private companies has been growing in popularity. In 2021, a record $18 billion was invested in smaller UK businesses. There are several reasons for this. Firstly, if you want the potential for high growth, you might need to look beyond the main stock market. For instance, some of the UK's fastest growing companies today are in the technology sector, which is materially underrepresented in the UK main stock market. Secondly, investing in private companies can add diversification and potentially value to your portfolio. Private equity and venture capital have outperformed listed equities over the last 10 years. Thirdly, many high net worth and sophisticated investors are entrepreneurs themselves, and investing in high potential companies is a natural fit as they understand the challenge of scaling pioneering business models and technologies. Of course, investing in early stage private companies is high risk. The failure rate for young businesses with few proof points is high, and there is typically no ready market for private company shares. That is why the government provides tax incentives such as SEIS, EIS, and investors' relief to encourage investment at these early stages. The tax reliefs on offer help to mitigate those risks and amplify potential returns. So what kind of companies might you invest in? They are typically young companies ranging from pre-revenue startups with no market-ready product to maturing and sometimes profit-making companies with highly valuable IP and global blue-chip customers. One way to get exposure to private companies is to invest in a venture capital fund. So it's the manager's responsibility to find, select, and monitor investments. An alternative, or in addition to that, experienced investors may also want to select their own private company investments. This could be more rewarding, but also higher risk with no diversification. There are a few challenges to overcome. Unless you are well connected or have a team dedicated to generating deal flow and carrying out due diligence, it can be difficult to source and gain access to the most attractive opportunities. Accurate and relevant information on companies can be hard to pull together. Transaction costs can mount up, and the whole process can take many weeks. So who are Wealth Club and how can we help? Wealth Club was set up in 2016 to provide compelling investment opportunities for high net worth and sophisticated investors. We are now one of the most active investors in early stage companies in the UK outside of London. On average, members of Wealth Club collectively invest around 30 to 40 million a year directly into private companies. First, our team of corporate finance and investment specialists constantly work to find and access the best deals. We look for good quality companies with high growth prospects and experienced management across a range of sectors so our investors can build their own diversified portfolio. Whilst we don't audit the information provided by the company, and our reviews are not a recommendation to invest, we make sure we have reviewed all the critical areas of the deal, making sure we get our questions answered and where we think necessary, improving the terms of investment for our members. We set out both risks and opportunities in an easy to digest, transparent way so our members can make an informed investment decision. We co-invest with a number of parties, including VCs, private equity funds, corporates, and super angels. Our typical funding rounds range from 1 million to 5 million. Usually, investors can access our deals with a minimum of just £20,000. Many of the private company investments Wealth Club offers are eligible for EIS tax relief, which provides upfront income tax relief of up to 30% of the amount invested. Under EIS, there are also capital gains and inheritance tax benefits, and loss relief if an investment results in a loss of capital. You can read more about EIS tax reliefs on the Wealth Club website. Remember, tax benefits can change and benefits depend on circumstances. Private company investing is not for everyone. It can be complex and high risk and is only for sophisticated and high net worth investors. A common rule of thumb is that in a 10-company portfolio, you should expect 3 or 4 to fail completely, 3 or 4 to return some capital, and 1 or 2 to do well, in some cases well enough to outweigh the losses on the other investments. You should not invest money you cannot afford to lose. Our review process should help mitigate some of the risks, but this remains a high-risk area of investment. Your capital is at risk. There is no guarantee of any investment return at all. This sort of investment is illiquid, long-term, and does not provide a reliable source of income. If you are a high net worth or sophisticated investor and want to find out more, please call our office and a member of the deal team will help you. Alternatively, go to our website and register for deals.